we are offering. So the Mahindra Mutual Fund, we were the latest entrant in the fund business, and the reason to do the business, like every other major Mahindra initiative, this business, the purpose is to go to smaller cities and smaller towns in India, even rural at some point in time. Our parent company is Mahindra Finance. Mahindra Finance, as you know, is one of the largest rural penetrated NBFC in the country. They have presence in more than 1150 cities, and they market their loan in more than 300,000 villages. Our goal over a long term is to go to every place where they are. In that sense, we are different from other mutual fund companies. Our goal is to reach all over India in every small city, in every village if possible. That is the main goal. And that is why, while we came late, we were the last entrant, we are very clearly focused on a different market. And that is the reason why you can see that our schemes are named little differently. The name of the scheme will normally not be in a full English. We use a little bit of English because when you go to South India, etc., a lot of people don't necessarily understand Hindi and other languages. So we use a mix. To give you an example, our tax fund is called Kar Bachat Yojana. It's a straightforward proposition. You want to save tax, then you have to invest in a tax scheme. So similarly, there are other schemes. For example, our multi-cap scheme is called Badhat Yojana. Simply, it means growth scheme. So like that, we are trying to make people understand the concept of investing by talking the language of the people. That is our approach. Our main business is done through financial advisors, which are individual financial advisors, because markets we go to, there are no brokers or banks or distributors. Mostly there are individual financial advisors are there. Today we receive money. We are only, our age as a fund company is not even 18 months. But we receive money from 300 cities. That is not like any other mutual fund. Mostly when you start a new mutual fund company, you will do business in the top few cities, and then slowly you will expand outside. But we have decided that our approach is going to be all over India. So that is how we are different from the others. So far, we manage about an average of 3,000 crores of assets, which we have accumulated over the last 18 months of our existence. This is our next equity scheme. So far, we have 3 equity schemes. This is the 4th one. The 3 equity schemes we have, one is a tax saving scheme, second is a multi-cap scheme called Badhat Yojana, and the third is a scheme that has more of a balanced approach. It is called Dhan Sanchay Yojana. It has 50% exposure to pure equity, 50% exposure to 35% exposure to pure debt, and 15% exposure is to arbitrage. So that is more like a balanced approach, but it's an equity scheme. This scheme we are now launching, and I'll give you a reason for this. It's called Unnati for a good reason. Unnati is a word used in Indian languages for something that is going to sharply rise. It is the intention for the companies in which we are investing are emerging businesses, and they will see Unnati come to them. And with that, Unnati will come to the Indian economy. I could take you through the presentation, but more than the presentation, let me give you the logic of doing this fund now. As an economy, we have been through 2 landmark events which any economy, they happen once in a lifetime. Number one was the demonetization. I think the demonetization happens maybe once in 50 or 100 in our economy. And we change our entire indirect tax base. That kind of event happens even more rarely. Now, when that kind of event has happened, obviously there were a lot of businesses that had to stop, rejig themselves so that they can face the new reality of the market. 1 year, obviously the GDP growth slowed down, and we saw switch over into the new world. But as we speak, in this quarter, which is October to December quarter, we as fund managers are seeing that all the businesses are coming back on rails. But starting with the mid-sized business. If you think about the mid-sized businesses, to give you a sense of perspective of the size of business and the size of its investment growth, SEBI has defined large cap as those companies which are number 1 in market cap to number 100 in market cap. They have not put a number for the market cap. They just say number 1 to 100. Number 101 to number 250 is mid cap. Today, the lowest one, the 250th company, the capitalization is about 9,500 crores. So it is not a small business. These are mid-sized businesses, and these are the businesses in which over the last 3 years, including the last 1 year where the economy went through the hiccup it went through, the earnings growth on an average is in excess of 17%, which means earnings of these companies have grown by, on an average, by 17% and more. If you compare that to large cap companies, the earnings of the large cap companies in the same period has grown by about 8%. So not surprisingly, we believe that these are the companies in which more value is being created, and therefore more investment should go into those. That is one part. The second part is, if you look at the ownership of these companies, most of the mid-cap companies are owned by either large industrial groups or individual promoters. In these companies, still, the international and institutional ownership of investments is below 15%, which means earnings are coming in fast, ownership is not very institutional, and therefore there's an opportunity for somebody like us to own more. If we go and try to own a large cap company that is already owned 40-50% by institutional investors, there is not that much headroom for it to grow in terms of valuation. In terms of valuation opportunity, growth will come in these companies which will eventually become large cap themselves. So if you take examples of companies that were not large cap but became large cap, and let me give you some example of that. These are companies, these are examples. I'm not recommending any of these companies. I'm just giving you examples. So if you take Nifty 50, you take a company like Bajaj Finance. From 30th August 2017, it became part of Nifty. But before that, it gave an annual return over the 3-year period before, over the 5-year period before that. It gave an annual return in its stock of 77%, right? Now, I wish I had invested in that company in 2012, correct? So those are the kinds of companies we are now looking for, that over the next 5 years can become part of the Nifty. But in the meanwhile, they will give you a fantastic return. You take Hindustan Petroleum, you take United Phosphorus. At the same time, there are also companies which didn't do that well, who lost focus from their business, right? You had Bharti, Tata. So some of these companies lost focus, which are actually they were members of Nifty, but underperformed. So when you invest in very large caps, you could have these situations. But when you invest in selected fast-growing companies that are taking advantage of the economic growth, then you have these kind of situations. You have Aurobindo Pharma, you have iSure, you have India Bulls, you have Bajaj Finance, you have Hindustan Petroleum, United Phosphorus, which have all become now large cap. So we are not investing in those anymore. This fund will invest 65% of its money, at least 65% of its money in the mid cap. We are now looking for those companies, and we have identified a portfolio of about 35 to 40 companies, which from here will show valuation growth. So that is the reason. We believe that this is the time to invest in mid cap. A lot of people ask me, but mid caps valuation is very high. But the fact is, if earnings is high, if earnings is in excess of 17% growth, then obviously valuation will be higher. No, why are we surprised? But we believe a lot of money has yet to come into the stocks of a large number of mid caps from here onwards, because earnings will first come there. And like I said, ownership is not enough, and therefore ownership will rise, and both of them together will give a rise to the. That is the simple reason why we believe that this is the time that we should be investing in mid cap stocks, and therefore the Unnati Emerging Business Yojana is what we are bringing to market. There is another. When you talk about the economic growth, this is India's GDP growth. We took from 1947, we took 60 years to become a $1 trillion economy. 2007, 60 years. But what we did in 60 years, we repeated in 10 years or less than 10 years. We became a $2 trillion economy in less than 10 years. We believe that the next trillion is not even going to take 5 or 6 years. And the next trillion after that will not even take maybe 2 years. That is how rapidly the development of the economy is happening. The other factor which you need to know is when GDP grows, market cap grows along with it. Today we have reached approximately 90% of our GDP in terms of market cap. I think GDP is about 2.4 trillion, 2.4 trillion. Market cap is about 2.1 trillion, thereabouts. That's the ratio today. But what is it made up of? Let me give you an example of how in other countries, when the GDP grows, in the market cap, what grows? Look at China. Till 2007, both the blue line shows growth of caps and the red line shows growth of large caps. In China, which grew how we are going to now grow, up to 2007, both were growing equally. But after the global financial crisis, when China decided to do quantitative easing and get into the global market big way, look at the way the mid caps have completely outstripped large caps. So when GDP goes into high gear, the growth actually comes from the mid caps. It is the mid caps of any economy that create large scale employment, that create entrepreneurship, and that build the economy. It is true for China, equally true for America. Up to 2006-7, mid cap used to lag the large caps. But look at it now. And these are two of the best performing markets in the world. India in the last 3 years is only the 4th or the 5th best performing market in the world. The best market in the world was USA. followed by, I think, England, Japan, China, Germany, all of them. But this is true for all markets. That when the economic growth sharply rises, it's the mid caps that perform. So for our time has come now. This is our chart. We are now at an inflection point where the mid cap is about to rise above the large cap. And we know that our GDP is rising fast. And when the GDP rises fast, it's the mid caps that will rise most. So even from a macroeconomic perspective, we think timing is now to put your money in mid caps. They will see the maximum rise. Of course, you have to select the right ones. You have to know it's not across the board. Every mid cap is not going to perform, but you have to see company by company. So in terms of sectors, for example, we believe today consumption sector will attract the most amount of money. When I say consumption sector, what does it mean? You know, people are buying durables. You look at mid cap auto companies, right? You look at and auto related, right? You look at anything that has to do with homes, whether it is small durables, large durables, home purchase, home rebuilding, home decoration, all of that is going to see a big rise because we are in the consumption mode and consumption is coming back. People who could not spend the money because they didn't have money in hand are now spending the money. Right? Demonetization is over. People who could not sell because GST was a problem are now beginning to sell because now that problem is ironed out. Right? So we are seeing all that coming back. Because that is coming back, a sector in the mid cap which is coming back very fast is the BFSI. When you want to buy a home, you want a loan. You want to buy a durable, you need a loan. You want to buy a two-wheeler, you need a loan. You want to redo your house, you get a home redoing loan, right? So related sectors to consumption, we believe, are the areas where initially at this stage we will look for opportunities more than, for example, in commodities or let's say in industrials, which will probably see the next leg of benefit coming. So if today consumption sector is rising, then it rises for the next 1 or 2 years, then it will need more capacity. And when it needs more capacity, then the capital goods sector rises. So we see the consumption sector leading the way in the mid cap area, and that's where we are going to focus our portfolio, and that's the new fund that we are offering. The basic presentation on the fund is that it is 65 to 100% it can go into mid cap companies, and the remaining can go into non mid cap on a selective basis. We may find something which is still very interesting in the small or in the large, right? And but everybody who is running a mid cap fund will have to follow this now, right? So all the different mid caps fund around the country that you currently see, they'll all have to follow this new guideline now, and that's the basic fund structure. Investment strategy will be very, very active. We will individually pick stocks. We are not sectoral focused. It doesn't matter which sector, but yeah, largely we are seeing consumption sector, but consumption sector is very, very large. There is another sector, for example, which is rural based. We believe a lot of consumption will happen there, right? And because rural did not go down, even with demonetization, everybody expected there was a small hiccup in rural market, but it just because of the good monsoons and the good crops, the crops didn't suffer. So they are doing well. So we are seeing opportunities there also. So that is where we are going to find individual stocks. It will be bottom up approach, and we'll build a portfolio to capture this growth opportunity of India. That's fundamentally, we think India growth means the mid-size and the small businesses growth. So that's pretty much what I have to say about this fund. The minimum investment size is 500 rupees. 500 rupees is the minimum investment size. So it can start really small. This has been done by us, keeping in mind that we are going out to small investors also. So please ask me questions. As the fund that has the maximum number of investors from small towns and villages, that is the goal. We don't want to target AUMs. Whatever the AUM, we have no ambition to be the largest fund. Absolutely no ambition to be the largest. Targeting AUM, my friend, in this growth market, we could have easily got 10,000 crores. I am targeting number of cities, 300 cities. You show me another fund house which in 18 months, first 18 months of his life went to 300 cities. Nobody does that in India. I don't know if you people realize this. The big problem now, the traditional investment mode for a small investor in small city or village in India, first of all, his income was not like salary. Salaried class has less than 20% ownership of livelihoods in India, correct? Less than 20% of Indians earn their livelihood through salary. We are talking to people who have some form of business, whether you call it farming, whether you call it dal mill, whether you call it small engineering works, whether you call it kirana shop owner, whatever. These are our customers. They make money 2 or 3 times, they make lump sum money. They have no regular income, right? These people, whenever they got a little bit of extra money, would buy a small piece of land or they would put money in gold, correct? That's the number one and number two investment of all of us. Yeah, we have in cities become a little smarter. We put stocks, we put FD or whatever. But these people only put money in those two things. In the last 5 years, the price of land in India has risen from 10 to 10,000 times. depending on which part of India you go to. Correct? You know it. Now that fellow who used to put money in land can no longer put money in land. In fact, he is looking at how to sell one piece of land. Some road is being made, sell it, make some money. But he also knows that he can no longer buy land. What to do with the money? He doesn't know, because traditionally from across his generations, land was being purchased. Gold has become more difficult to buy. It's become expensive. Okay, शादी है तो खरीदना पड़ेगा. But regular buying of gold has come down quite a bit. So we believe that these people need to be told about long-term savings in equities. Nobody can directly invest in equities because you can't do the research. So therefore, put in money in equities via mutual funds. We believe that is the message we want to take to these investors. They have a serious problem is there. When you go and talk to them, they don't know. There is a third problem. The third problem is that migration has picked up pace. You all must have lived in Hyderabad for a long time, okay? Or you may have come from another big city. But the fact is, when you live in small town in rural India, migration is part of your life. You are always hoping that if not you, your next generation will go and live a better life in some city. You don't want your children to grow up in that small village. Funding that migration is a very, very expensive cost. It is not something that you and I think about, but for them, that's a big. They have unique problems. Their largest untold expenditure is a funeral. If somebody dies, no bank is going to give you a loan to fund it. You have not saved for it. It is more expensive to do a funeral in a village than a wedding. So these are challenges that people have in those cities, and we think that if they systematically save in the mutual fund kind of a products, then there is a genuine service to those people we can offer. That is what we are trying to do. So about 1,000 crore has come from 300 cities.